Okay, good afternoon and welcome back everyone to our options education webinar series. My name is Tony Zhang. I'm the chief strategist here at OptionsPlay. And today we're here to talk about a very important topic for options traders, which is volatility. Understanding volatility is arguably one of the more difficult aspects of trading options, but it is very important in helping you fine-tune your option strategies. It is useful in a lot of different ways, everything from understanding what your potential P&L of a strategy is, to selecting your strike prices, to just getting a better understanding as to how option pricing works. So it's really important that we go through volatility, understanding what the different forms of volatility are, how you should utilize it, how they are generally calculated, and then understanding how you can use it for your own trading. So those are the things we're going to go over here today. This is a bit of a slightly more advanced course. This requires a basic understanding of calls and puts, and just generally speaking, how markets in general work between the stock market and the option markets on top of that. So we're going to discuss all of these things here today, but before I do this, what we're going to discuss here today is purely for educational and demonstration purposes. It is not a solicitation or recommendation to buy or sell any specific securities. So let's start off by talking a little bit about the different forms of volatility. Now, there is historical volatility and there is implied volatility. So we're going to discuss these two volatility factors, what they actually mean, and then talk a little bit about how option pricing models work, because that's really how we get a sense for the inputs of how we actually derive implied volatility. And we have to understand this first before we can talk about how we use implied volatility. That's during either to determine whether an option is cheap or expensive, whether we're looking at the option Greeks to help us determine which strikes we want to buy or sell. And at the very end, we'll take a look at some examples with a Q&A session here at the end to give everyone the opportunity to learn more about these types of strategies. So let's go ahead and get started. Now, the first thing I want to do is I want to talk about historical volatility, because this is the type of volatility that we are generally speaking most familiar with. So any equity trader, you're familiar with just the historical volatility of the stock. This reflects just how much the stock price moves up and down. The more the stock moves up and down, the more volatile the stock is. The less the stock moves up and down, the less volatile a stock is. So if you have a stock that moves in a relatively tight range or moves relatively slowly at a time, this is something that's less volatile versus a stock that goes up and down all the time. That's something that's more volatile. So it's simply measured by the average deviation away from the average price of a stock over a given period of time. Now, the key word here, in my opinion, is actually a given period of time, because to measure historical volatility, you have to determine what period of time that you are actually looking at that volatility over, because sometimes stocks will have small volatility during periods of time and then have explosive volatility followed by longer periods of low volatility followed by very explosive volatility. Now, many times if you're trading stocks, you're familiar with this type of pattern around earnings season, where you have long and relatively periods of quiet during when there's no earnings, followed by an explosive volatility when there is earnings, and then followed by muted volatility again. So it's very important that you determine, when we're thinking about volatility, not necessarily just in the form of when, how we're measuring volatility, but when we're measuring volatility. It's very sensitive to that, because if you look at a chart like this, where you have periods of extended muted volatility followed by very high volatility, it depends on how far you look back to determine the volatility of the stock. Because if you look back just a few days after earnings, you're going to see something that's very volatile. But if you look back, let's say, a longer period of time, you're going to get an average over a longer period of time. So it's important that you think about these factors when you think about historical volatility. So when someone says a stock's historical volatility is 30%, don't just take that at face value. Ask some questions. Over what period of time was that measured? Was that over a week period of time, a month, a year? Usually when we talk about volatility, we usually measure them in the form of a single year, meaning we want to have enough data to get a true sense for the volatility of a stock. So when we talk about historical volatility, many times we look at the annualized standard deviation of past movements. Now, you don't have to have a full year of data to get an annualized number. You can take a month, 6 months of data and annualize that number. You can even take 3 years of data and annualize that number. So we usually annualize it so that we have a normalized way of measuring or comparing stocks against each other, because you don't want to compare the 30-day volatility of one stock against the 90-day volatility of another stock. We always try to express them in annualized terms so that we can always compare one stock to another, apples to apples. So if we say one stock has a historical volatility of 20%, the other one has a historical annualized volatility of 30%, then we know the stock with a 30% implied historical volatility is more volatile than the one with 20%. But that's only true if we're measuring across the same time frame. So when we talk about volatility, the most sensitive part is actually the time frame of which we measure it over. Okay. Now, historical volatility is based on actual prices that have happened in the past. Now, when you're trading options, you might have heard of a term called implied volatility. So we want to talk a little bit about what implied volatility is. So implied volatility is the expected future volatility determined by the market. So how does the market determine future volatility? That's where we turn to option prices. And that's why we're going to talk a little bit about how option pricing is derived, because that's how we learn how to calculate the implied or the expected future volatility determined by the market. So before we were talking about what has happened in the past, right? So measure what price history is looking at. Now, implied volatility is telling us what does the market see is likely going to happen in the future, meaning how volatile does the market expect the stock to be in the future? Does it expect to stay the same, or does it expect some bigger moves going forward? And that's really where we turn to implied volatility. So what we're really looking at is the anticipated future volatility that the market is pricing given all the known information. Because the market, if you think of the market as one large auction where there are unlimited number of players buying and selling a specific asset and all known information is out there, then you can think of the market as a way to disseminate all the information that's currently out there. And that information is embedded into the price of an asset. Whether you're looking at the price of the stock or the price of the option, doesn't matter which asset class we're talking about. But whenever we look at the price of an option, we can use that to forecast the potential market price as to the magnitude, but not the direction of future price movements. So what this is telling you is that the implied volatility of an option, what it tells you is the expected magnitude, meaning how big we expect the future volatility is going to be. But what it doesn't tell you is the expected direction. And that is a very clear, that's a distinction that we need to make, that when we're thinking about volatility, we don't think about it in terms of direction. We think of it in terms of how uncertain we expect the future to be. If we think that the stock is going to be very certain, then you're going to see a lower implied volatility. If the future is very uncertain, then you're going to see a very high implied volatility. And IV, just like historical volatility, is always expressed as an annualized standard deviation. Because again, in order to compare apples to apples, we have to compare the same timeline as far as in terms of volatility. We don't want to compare the 30-day volatility to a 90-day volatility. You wouldn't be comparing apples to apples. So just like historical volatility, we always state implied volatility in annualized standard deviation form so that we can actually compare two stocks against each other. And what we can also do is compare the same stock against itself from, let's say, 6 months ago or 3 months ago or yesterday. We always want to know, how does the market expect the future volatility to be today versus where it was previously? Because that's how we can determine whether an option is cheap or expensive. And these are all the things that we use volatility for. So it's really important that we learn these things from a standard, or look at these things from a standardized view. So in order to talk a little bit about implied volatility and how we use it, I think we need to take a step back and take a look at option pricing models to get a sense for how we even calculate implied volatility. Because many times, historical volatility, we can show you the formulas for how to do them. But when it comes to implied volatility, that's where I think many users get lost as far as how do we actually come up with this number, or how do we calculate it? So this is where we turn to the option pricing models. And there's two general pricing models that I think most investors, if you learn more about options trading, are familiar with. The first one that you're going to learn about is the Black-Scholes formula. This is usually the first formula we learn in options pricing models. Now, Black-Scholes is a formula written in the 70s. It's derived from actually a thermodynamics formula. But what it does is it gives us a very good way of calculating the approximate value of a call or a put for a given option. There are some limitations to the Black-Scholes model because it's only applicable to American options, and it's really only useful for non-dividend paying stocks. When we think about European options, I'm sorry, they're only generally good for European options, but when we're trading American options, especially American options with dividends, that's really where the binomial tree model is more useful because it can account for discrete dividends, versus Black-Scholes only allows for a continuous dividend, which we know dividends aren't paid continuously. They're paid at discrete times a few times throughout the year. So there are some limitations to Black-Scholes, but both formulas, both option pricing models, all have the same variables, the same inputs that go into the option pricing model. So the models originally were created to help you back out a call and a put price. But in reality, what we have is we have a call and put price. The market tells us what a call and put is going to be trading at. So what we want to just explore a little bit is about how these option pricing works and how we derive that implied volatility. So if you think about an option pricing model, traditionally what we input is a stock price, meaning the current price of the stock. We enter the strike price of the option that we want to trade. We look at the amount of time that's remaining until expiration, that's expressed as a percentage of the year. We also look at the current risk-free rate of the markets. And then what we input is the volatility measured by annual standard deviation. Now, when we enter these 6 variables, what we're able to get out of these two models is a call price and a put price. But what this requires us to do is to input an expected future volatility, meaning what our expected volatility is going to be, and it's going to calculate for us what the appropriate call and put price is. However, in reality, what we have from the market is an actual call and put price. So what we're doing is we're basically reversing this formula. Instead of getting the call put price from the formula, what we're doing is we're inputting the call and put price from the market, and what we're getting back out of that is the volatility measure that we were talking about, and that is how we calculate the market's expected volatility. We're basically backing out, using this formula, from the call and put price that the market, or the mid price of the bid-ask quote that we're getting from the market, and we're using that to derive what the market expects the future volatility to be. And that is what we refer to as implied volatility. Implied volatility is simply what the market's call and put pricing is implying what the future volatility is going to be. Now, what we're also going to do is explore a little bit about how call and put pricing affects implied volatility, how when an earnings comes up, why implied volatility goes up, when an earning is finished, why implied volatility goes down, and what other factors are going into this model, because that helps you better understand this concept of volatility. And it's important that we also understand that volatility is not just a single number. Every single option that you can trade has its own implied volatility. Many times we think about implied volatility as a single number for a stock, but in reality, every single stock, if there are 100 options on that stock, there are 100 implied volatilities. How do you make sense of all of that? So those are some of the things that we're going to explore here today. But it's important that we first understand how implied volatility is calculated. It is backed out using these option pricing models, using the current call and put price, as opposed to getting the call and put price from the models themselves, okay? So before I move on, I just want to quickly make sure everyone understands the concept of the difference between historical and implied volatility. If that makes sense to you, please type 1 into the chat window. And for those of you that feel that you have an understanding as to how implied volatility is calculated, press type 2. If you don't feel that you have a clear grasp as to how implied volatility is calculated, that's okay, because platforms do the work for you here. You don't have to know how implied volatility is calculated. I presented it because I think many people are interested in learning, but in reality, you don't have to do these calculations. You certainly don't have to remember these types of formulas and do the math yourself, because again, all platforms, wherever you trade options, do these calculations for you. I just put this up to make sure people understand from a conceptual perspective. So now let's talk a little bit about what actually goes into a call and put price, because like I said before, the call and put price from the market is what is used to determine that implied volatility. So what goes into the call and put price? So here I have an example where a stock is currently trading at $20. So the stock's at $20 and I'm looking at a $15 call option. So a call option, that is $5 in the money because the stock is trading $5 above the strike price. Now, let's say this call option currently is trading at $7. What that means is that when a call option that has a $5, that's in the money by $5, what that means is that this option has an intrinsic value of $5. No matter what happens, if the stock stays at 20 and the strike price is at 15, this call option will always have an intrinsic value of $5 because a person can exercise this call option, pay $15, immediately sell the stock for $20 and realized a $5 profit. That's why it has an intrinsic value of $5. Now, if the call option is trading at $7, what that means is that the call option has $2 worth of extrinsic value and $5 worth of intrinsic value. Intrinsic value will never erode. An intrinsic value will always keep its value. However, the extrinsic value is what's going to erode to zero at expiration. At expiration, whatever extrinsic value an option has will evaporate completely and will be down to zero. Whatever intrinsic value is left, that is what the call option will be worth at expiration. So if whatever the distance between the stock price minus strike price, if that's a positive number, that's the intrinsic value that's left at expiration. Everything else as far as extrinsic valuation will erode to zero. So the extrinsic value part is the part that we really want to focus on because the extrinsic value is determined by the market's expectation of what is the probability of this stock being above a certain price at expiration. Now, the more volatile a stock is, the more the extrinsic value of the option is going to be because there's going to be a higher probability that this option will be in the money. The less volatile the stock is going to be, the smaller the value of that extrinsic value is. So in a very, very volatile stock, maybe the extrinsic value instead of being $2 might be, let's say, $5. So what you're going to get is instead of a call option worth $7, it'll be $10. So a more volatile option will have a higher call option value because the intrinsic value will stay the same, but the extrinsic value part will increase in value because the value of an option is determined by how volatile a stock's going to be. Now, vice versa, if let's say this stock is not very volatile at all, maybe it doesn't have $2 of extrinsic value, maybe it only has 50 cents of extrinsic value. So now the value of your call option, instead of being $7, will be $5.50. So whenever you see all these different calls and put values out there, they're really made of two components: an intrinsic value, which cannot be eroded, and an extrinsic value, which will always erode to zero. And the extrinsic value is actually the part that we always want to focus on when we talk about implied volatilities. So that's for a call option. For a put option, it's just the opposite, but a mirror image of each other. So if we have a put option that's trading at $25 and you have a $20 put option, A put option, whoops, this is backwards. This should have been $20. I apologize. This should have been $20, and this should have been $25. I will correct this in the slides before I send this out. So when you have a current stock at $20 and you have a $25 put option, this put option has an intrinsic value of $5, because again, someone can exercise this put option. They can sell the stock at $25 and buy it back immediately for $20 and realize a $5 profit. That's the intrinsic value part of the option. Now, if this put option is currently trading at $7, what that means again is that this put option has $2 worth of extrinsic value plus $5 worth of intrinsic value, which gives us the $7 put option. And again, extrinsic value is the value that will erode to zero. Intrinsic value is the piece that will not erode at all. So this is important in helping you better understand how a call or put option is made up, if you will. So a lot of people ask, how does a call or put option and the value of a call or put option get determined? It's these two factors. If there's any intrinsic value, that's added to the extrinsic value of an option. And the extrinsic value part of an option is purely determined by how volatile a stock is. Okay, so does that make sense, everyone? Please type 4 into the chat window if that makes sense to you. And the more volatile the stock is, the higher the extrinsic value. The lower the volatility of the stock is, the lower the extrinsic value of that option. So how do we interpret implied volatility? So we talked about the difference between historical and implied. We talked about how the implied volatility is actually calculated. It's backed out of the call or put option price. And then we determine what goes into a call or put price. So now let's talk a little bit about, once we're able to calculate this implied volatility, why does that matter? And what does implied volatility actually mean? And I have a few different examples to give you a better understanding as to how to interpret and view this data. So here I have a $50 stock, and based on the call or put option of that stock, I've calculated the implied volatility of this stock is 20%. So what I'm going to do is I'm going to show you how I should use that 20% number to determine how should I use this number in general. And the general use of implied volatility is to give you a sense for what is the expected trading range of a stock in the future, because we can use this number as an annualized standard deviation, meaning what we expect the stock to trade in over the next 1 year's time frame. So if you have a $50 stock that has a 20% implied volatility, what that means is that over the next year, we expect that the standard deviation of that stock is going to be $10. And what does $10 represent? That means that if we look on a bell curve, and we know a standard deviation reflects this bell curve right here, one standard deviation. One standard deviation equals to roughly 68% of the time, the stock will be within these two bounds. So if the two bounds are $10, what that means is that there's going to be a 68% chance that the stock will be between $60 and $40. So the stock's currently at 50, and we're saying that the 68% chance that the stock will be between 40 and 60. There's only a 16% chance that the stock will be below 40, and a 16% chance that the stock will be above 60, because that's $10 above and below the current price. And we calculate the $10 because we take the current stock price, multiply it by the implied volatility. That gives us the 1 year expected move of this particular stock. Now, how is that important? Why do we want to know these numbers? This is important because think about it. When you're buying a call option, you need to know that the stock needs to move a certain amount before that call option makes sense, right? How do you determine what is a reasonable amount for the stock to move? That's where implied volatility comes in. Because if you're going to buy a call option, you want to know what is the probability of the stock reaching my target price. Maybe that the probability of reaching your target price is only 5% or 10% or 30%. Implied volatility helps you calculate what is the probability of the stock moving that amount. And also, when you know that the majority of prices are going to be between, let's say, 40 and 60, that might also help you determine where should you sell perhaps a covered call or a cash secured put or a credit spread. These are all things that we use as traders to help us determine our strike prices to buy and sell. Because generally speaking, if we're going to buy, we want to buy a strike price that's within this range, because we need the stock to move within that range in order for it to make money. Now, if let's say you were selling an option, you might be more inclined to sell options out here because you want something with a low probability of hitting your strike prices. So this is really how, as traders, we use implied volatility to help us determine the expected trading range of a stock. And just to give you a better understanding as to how this is used, here I have a $50 stock that has a 20% implied volatility. That means in the next 1 year, I would expect in 68% of the time, the stock will be either above $10, between above or below $10. Now, that's an easy example, but what if now I have, let's say, a $100 stock with a 10% implied volatility? Now you can do the same exercise. You can take the stock price, multiply it by the implied volatility, and what you get also here is the implied standard deviation. So now I still have the same $10 move, but the same $10 move is now on a $100 stock. So now I have a 68% chance that the stock's going to be between 90 and 100, and there's a 16% chance it'll be below 90 and a 16% chance it'll be above 110. So this is really, some I would say very high level examples of how you should think about implied volatility. And again, this is less so how you would use it in practice. This is more to give you an academic understanding as to why implied volatility is important. But in reality, I'm going to give you some examples that's going to shift the way that you think about this. But before we do that, I just want to make sure everyone understands how you should think about implied volatility, because we state always implied volatility in annualized terms. So it's important that you understand how it's applied to annualized terms. What you do is you take the current stock price, multiply by the implied volatility, and what you get is the expected 1 year, one standard deviation move of the stock. If that makes sense to you, please type 5 into the chat window. Now, many people will ask, why do I care what the 1 year expected move of a stock is? And the answer to that question is you really don't, because rarely do you happen to trade an option that expires in exactly 1 year from today. So let's put this in actual practice, because when we're trading options, we're rarely trading options that expire in 1 year. So we don't necessarily want to know what the expected range over the 1 year is. We might want to know what the expected range over the next 30 days is, or the next week, or the next 2 weeks, or whatever amount that you're trading with. But this is really how we start building the foundation of understanding expected trading ranges. So here I have a real example, BMO stock. BMO stock earlier today was trading at $76.32 Canadian. And at the time, the implied volatility of the stock was 24%. Now, BMO reports earnings tomorrow, and the current 53-day option, which is the October 16th expiration, which is roughly 53 days away. How do I know what the expected trading range over the next 53 days is? The reality of it is that it's a fairly complicated computation. It's not easy to back out what the expected trading range over the time frame that you care about. I can take 76 and I can multiply it by 24%. And if I do that, let's just quickly show you this, 76.32 times 0.24. This will tell me that the expected 1 year range of a BMO is $18.31. But what if I'm trading earnings over the next few weeks? Well, I don't want to know what the 1 year expected move is. I might want to know what the October expected move is. And that's really where you turn to tools like OptionsPlay. For those of you that have access to OptionsPlay, you can see how to access this using your, whoops, looks like I got logged out here. 1 second. So when we're looking at BMO, what we have here on the very bottom of our screen is a trading range simulator. What this allows you to do is actually select any expiration date that you want, whether you're looking at a weekly option or a October or December or January option, What we calculate for you is the expected trading range using the implied volatility of that expiration date. So like I said, every single option in itself has its own implied volatility, but we always, generally speaking, generalize a single expiration date's volatility. So as you can see, August will have a fairly wide implied volatility because it encompasses the earnings that we're expecting that BMO is going to report tomorrow. As you go further out in time, the options get a little less sensitive to that one-day move expected to earnings. So what you can do using a tool like OptionsPlay is not only calculate what the 1 year expected move is, but what the expected move of the time frame that you care about. Which time frame do you care about? You generally care about the time frame that you're trading. So if you're trading an October expiration date, you care about the October trading range. If you're trading a December expiration, then you care about the December trading range. And this is very useful, and I'll show you here in a few minutes as to why this is so important, because a lot of strategies such as buying a call option or maybe selling a put option, these are all strategies that technically have unlimited max rewards. But in reality, there's an expected trading range. So you can use that expected trading range to give you a better sense for what the risk to reward of a strategy actually is versus calculating unlimited risk reward or calculating risk reward at something with unlimited risk or unlimited reward is impossible to do. This is really where a trading range gives you a very good sense for, I think the stock is likely going to trade between $69 and $84. So what is the max potential gain of this call option within that expected range? That's how we calculate the OptionsPlay score. Now, if let's say you have a wider than expected range, then you can have potentially more profits on a call option like this. The higher the expected range, the more potential profits you have, the better the risk to reward ratio looks. But in normal circumstances, the risk to reward in this particular case doesn't look that particularly attractive. So there are so many things that are being influenced by the implied volatility of a stock, but in theory, but in general, what we're really doing at that implied volatility is calculating the expected range, which is what we use to help us calculate our strike prices. So when we're thinking about trading a vertical spread, how do we determine which strike price to sell? Guess what? We're using the one standard deviation move of that expected, the expected move of that expiration date to say, well, the standard deviation move here is around 84, so we should sell an $84 call option because that only has a 16% chance that the stock's going to be above that strike price. So this is really where all the different places that you'll end up using implied volatility in your trading, in strike selection, in understanding what your potential P&L is, and understanding what the expected future volatility of a stock is. So just a few different things to account for here. Now, the call option here at the time was $3.15. That gave us a 53-day implied standard deviation move of plus or minus $7. So roughly $7 higher, roughly $7 lower. That's the expected move with a 24% implied volatility on a $76 stock. Now, why do we use implied volatility? Because there's another quick and dirty way that many times traders will get a sense for whether an option is cheap or expensive is we take the option price and we divide it by the stock price. So if today it's $3.50 for a call option on a $76 stock, that is roughly 4.6% of the underlying stock that we're paying for this call option. But the problem here is that this is for let's say a 53-day option. But maybe next week, this option is now only a 46-day option or 47-day option. And then at this point, the option is a little cheaper. But maybe at that point, time has gone by. So this is the extrinsic value piece that starts to erode. So in order to compare apples to apples, we always use an annualized implied volatility, because an annualized number allows us to compare a 30-day option to a 60-day option to a 90-day option, because we're always expressing the implied volatility using the annualized number. This way, we're always comparing apples to apples. Does that make sense, everyone? Please type 6 into the chat window if that makes sense to use. Okay, perfect. I see a lot of sixes. Now, I know that this is, again, an advanced topic, and I don't expect every single person here on this webinar to get everything that I just spoke about. But that's why we, at the end, give everyone an opportunity to ask questions. So if you have questions, please type them into the Q&A window. There's a chat window and a Q&A window. Feel free to type your questions in the Q&A window as we're going along, because I'll finish at the end. I'll come back to the Q&A session and make sure that we answer those questions there for you. So when you think about an option here, BMO happens to report earnings tomorrow. So what happens is that the option is going to naturally be more expensive, which means that the implied volatility gets higher. The expected future volatility of BMO is going to be pretty high right now because there's a lot of uncertainties with what's going to happen between now and the end of day tomorrow when BMO announces earnings. Once they announce earnings and the information is now available, the uncertainty is evaporated. The uncertainty is no longer there. What happens is that when all things are kept equal, once the earnings comes out, even if the stock stays exactly the same price, meaning assuming that everything stays exactly the same, the stock price, the strike price, the amount of time left to expiration, what's going to happen is once the earnings announcement comes out, that uncertainty goes away. And what happens is you're going to see the extrinsic value of the option start to decrease. It might decrease down to, let's say, $1. So what that means is that now the put option, instead of being worth $7, is now only going to be worth $6, given all things, everything else held constant. Now, in reality, things aren't always held constant, which is why, again, instead of just looking at the extrinsic value of an option, we look at the implied volatility of an option, because again, that normalizes and standardizes everything. So when the value of an option decreases from $7 to $6, that's also at the same time going to decrease the implied volatility. So when we decrease the implied volatility, what happens is that when we decrease this number, when this number gets decreased, then the entire implied standard deviation range is also decreased. So what you're going to see, expect tomorrow to see on BMO is that if everything else held constant, what you're going to see here is that if once the earnings announcement comes out tomorrow, the same October 16th option, instead of having a $7 implied deviation move, it will likely be something like maybe a $6 implied deviation move, because that uncertainty is evaporated from the market. So what that means is that if, let's say tomorrow you're trying to buy a call, a debit spread like this, if let's say the stock price is still trading at $76.85, what you're going to see, instead of trading the $76.84, you might end up trading the $76.82, because the implied volatility is lower, the expected trading range is narrower. So when you're selecting your strike prices to sell a cover call, to trade a debit spread, to sell a credit spread, they're all going to change. So that's why it's so important to understand the concept of implied volatility, because it affects so many parts of your trading strategy. It affects your strike selection, it affects your expected trading range, because the expected trading range is also a factor in determining where the stock can go. If you constantly choose outlooks where the stock price is greatly exceeding your implied, the expected trading range, yes, if you bought a call option, you get a 378% return, but the probability of that happening is pretty low. You have to always be reasonable in understanding what your potential market outlook is. So if you're thinking about buying a call option, you might want to be more realistic as far as where you think that stock can go. As we showed you in this particular case, the expected trading range for BMO is somewhere between up or down $7. So up or down $7 from 76 is about $83, $84. So that's how I can say reasonably that I think that it's reasonable for the stock to get up to $83, $84, but it's not as reasonable for me to think that the stock's gonna get up to $92. It's possible, but it's very, very unlikely. So these are the ways that you want to utilize these trading range, utilize the implied volatility, which determines the trading range, to help you select your strike prices, and more importantly, help you also get a sense for realistically how much money can I make or lose from that option. And many times you might actually bring up a call option, see that within the expected trading range, the returns are pretty low. So when you have options that are really expensive, many times what you'll see is that even if the stock reaches that 1 standard deviation move, your returns are pretty low, 19, 20, 25, 30%. And you might say to yourself, even if the stock makes a significant move within its trading range, I'm still looking at pretty low returns. That's an indication that I don't want to buy that stock, or I don't want to buy that option. And maybe I can see if I can help find some examples here. Let me just look at a smaller price stock here. So let's see. I don't know anything about these particular names. Let's see if I can find one that looks particularly bad. None of these look terrible. Let's see. Okay, here's one. It's got a pretty low options play score, right? So as you can see, even if the stock reaches its 1 standard deviation move, so in this particular case, that's about $51.85. So this is BMO Asset Management. This is the S&P 500 ETF. Okay, so in this particular case, this call option is pretty expensive, $240. It's denoted by the OptionsPlay score. Now, how do I know that's expensive? Because as you can see here, even if the stock reaches that 1 standard deviation move, I'm still only looking at a 60% return on my capital. And remember, I'm risking 100%. So in a good scenario, I'm looking at a 60% return while I'm risking 100. That's not really one that I want to take. So this is all the different ways that volatility is connected to all the different aspects that you have to look at when you're trading an option. Strike selection, P&L calculations, these are all really important factors to remember. So when you're thinking about trading options, these are all things that you want to remember. So a quick summary, implied volatility, what it is a normalized metric, meaning it's always calculated based on the annualized expected future volatility. It's calculated off of the call and put price of an option. We always back out the implied volatility by looking at the call and put price that the market determines. When we think of the market as one big auction, right? So if let's say BMO earnings are expected to blow it out of the water and everyone expects BMO to make a big move on to the upside, guess what happens? Everyone's going to be buying call options, and maybe instead of costing $7, that call option is going to cost $9 or maybe $11. And what that does is the higher the call option price is going to be, the higher the implied volatility is going to be. So the market itself, you and every other participant in the market combined, you guys are determining the price of an option. The higher the price of the option is, the bigger the expected move is going to be on earnings tomorrow or next week. And the lower the implied volatility or the lower the expectation is, no one's going to want to pay a lot for that call option. So if let's say everyone thinks that BMO earnings are going to go nowhere, it's just going to stay where it is, no one's going to pay a lot of money for that call option. So maybe that call option goes from $7 maybe down to $5 because no one thinks it's going to make a big move. No one wants to pay a lot of money for that call option. So when you get a decrease in that call price, what you get is a lower implied volatility. That means a smaller expected trading range, the call options are going to be cheaper, and you're going to naturally select strike prices that are closer away. So when people ask us about options play, do we factor into these things like implied volatility? The answer is yes. All of it is connected. So when you use options play to select a cover call, let me go back to BMO real quick. When we use when you use options play to select a cover call, and you look at the September $81 cover call, why did we select the September 81s? Because if you look at the trading range simulator and you select the September expiration date, guess what? The 1 standard deviation movement is about an $81 move. That's the closest strike price. That's why we automatically select that $81 strike. Now, if let's say BMO earnings, on earnings, the stock moves a whole lot tomorrow and maybe volatility expands, then what happens is we're going to naturally select a strike price that's further away. And if volatility is lower, we're naturally going to select a strike price closer because implied volatility is adjusting this bell curve. The higher the implied volatility, the wider this bell curve is. We're going to select a higher strike price to sell for cover calls. When implied volatility is low, the bell curve is going to be narrower. We're going to naturally select a lower strike price for your cover call. All these things are connected, and it all comes down to calculating the implied volatility from the call and put price that's determined by the market. And when I talk about the market, that includes you as a market participant buying and selling calls here in the market. So what we use these implied volatilities for, we do everything with it. We calculate option Greeks. Option Greeks are calculated off of implied volatilities. We use implied volatility to determine if a call is cheap or expensive. So, you know, if an option normally trades at 24% vol, all of a sudden it's trading at 30 vol, now that's expensive. So we can look at what volatility does a call option typically trade at, and then look at it compared to history. That's how we can determine whether a call option is cheap or expensive. We use the implied volatilities to back out the expected trading range, and I just showed you how that's useful in helping you all the different things from selecting strike prices, calculating potential P&L. It's also useful in helping you determine the appropriate strike price to buy or sell, because if you're buying, you want to buy something within the trading range. When you're selling, you generally want to sell something outside of that trading range. Always put probability on your side by using these types of metrics. And lastly, I think one of the more important aspects that many of you are using is to determine what is the likelihood of profit or loss of a strategy, because at the end of the day, anyone could put in any possible market outlook, but you always want to put an outlook that's reasonable. And the trading range helps you determine what is a reasonable outlook for a stock. And that helps you determine what is my maximum profit, what's my maximum loss. Am I comfortable with both of those before I place a trade? Those are the important things that you need to remember, and they are all stemming from implied volatility. So if prior to today, you didn't have a good sense for implied volatility, you didn't understand why it was useful, I hope that this enlightened you to show you just how important it is and how interconnected it is to almost every aspect of your options trading. If you have learned about implied volatility before and you want to learn more, I hope that this inspired you to take a little bit deeper understanding of implied volatility, because again, it's so interconnected with everything that you do with your options trading. So with that, that covers what I wanted to show you here today regarding implied volatility, option pricing, and how it's affecting everything that you use for your trading decisions. So with that, what I'll do is I'll open this up for Q&A. I know many of you are likely going to have a lot of questions around implied volatility, and I know this is one of the topics where the spectrum of awareness is pretty wide. There are some investors, especially if you're starting out, that this might be the first time you've ever heard of implied volatility, and this is probably quite over your head for if this is your first time learning about implied volatility. And for those of you that have experience trading, you might have a lot of advanced questions regarding implied volatility. So please bear with me as I answer your questions, because like I said, usually when I talk about this topic, the types of questions run a pretty wide spectrum. So with that, thank you so much for your time this afternoon. What I will do again is please type your questions into the Q&A session. That's where I'm going to answer questions out of. So Anil is asking, can this forecast the IV, can this forecast of IV can be differently calculated by different persons? Yes, however, I would say the different methodologies for calculating IV will result in fairly small differences. So you might use one model and get 27, and I might use a different model and get 28, but we're not going to come out and get drastically different IV numbers. You're going to get slightly different numbers, but they're not going to be very far apart. Great question. Does it also have to do when the contract is expiring? Absolutely. So as options approach expiration, implied volatility becomes more and more sensitive, because at the end, your extrinsic value is extremely sensitive to small movements. So yes. Can you give me an example on a daily basis? So you certainly can. One of the metrics that we usually use, or a lot of traders use, is they take the implied volatility and divide it by 16, and that gives them the 1 day expected move. Because the 1 day expected move, 16 is roughly the square root of 252. So if you do the square root of 15.87. So what you can do is you can take 100 times 0.1, 0.1 divided by 16. Whoops. 0.1 divided by 16 is that, multiplied by 100. That is your expected one-day move of a $100 stock with a 10% implied volatility. It's 62 cents. So that is one quick and dirty way, if you will, that you can take the annualized implied volatility and get a sense for what the one-day expected move of a stock is. Roger saying, how did you choose a 53-day option? I didn't. That was just the first default trade that I was looking at. You can use any option to do these calculations for. Does Ivy take care of expiration dates of contracts? Kunil, I'm not sure what you mean by that question. If you don't mind rephrasing, I'm happy to help you answer that question. Raymond, good afternoon. Thank you so much for joining us. Barry is asking, hi, Tony. If a stock makes the anticipated move in one direction expressed in the IV, does the IV remain the same or does it either rise or drop as the move has occurred? So Barry, IV is the future expected volatility. It has nothing to do with what the stock has done historically. Granted, when the stock moves a whole lot, generally speaking, that will impact implied volatility, but the two are separate. So it's important that we separate the two. The stock can make a big move and the market expects after that that the stock's not going to move at all. So you can have the stock make a big move and implied volatility actually move lower. So the two generally are correlated to each other, but they don't necessarily have to move in conjunction with each other. Wallace is saying, hi, Tony, is the binomial tree model path independent or not? Does the sequence of events up or down matter? It does, and that's exactly why we use the binomial model, Wallace, for, I would say most option pricing models don't use Black-Scholes because of the limitations that Black-Scholes have. We always use, almost always we use the binomial model. Jan is saying, can you clarify, please, the following? And then it's blank. So Jan, could you possibly fill in the blank? And I'm happy to clarify the following. Wallace is saying, hi, Tony, regarding the implied volatility, can we convert the annualized IV to daily IV? So you can, but here's the thing, right? I don't know why you need to calculate. So I just showed you the method for calculating the daily IV. Or the daily expected move. But I'm not sure what you do with that. So let's say I know this $100 stock has a daily expected move of 62 cents. What do you do with that? You can't trade a one-day option. You can only trade an option that expires every single week. So you only need to know the expected move of the expiration dates. I only need to know the expected move of August. I only need to know the expected move of September. I only need to know the expected move of September 11th, because those are the only ones that you can trade. You can't trade a one-day option on BMO because there is no one-day option on the BMO. The shortest you have is a 4-day option. So you can use it to calculate it, but I'm not sure what you do with that. Does IV take care of expiration dates of contract? So Kunal, I'm still not sure I understand that question. If you don't mind clarifying, maybe you've typed in later and I'll look at that. Is the extrinsic value equal to the time value of the option? Yes, the extrinsic value is the time value of the option. Roger saying, how did you choose a 53-day option? So it's just the default expiration that comes up. You can choose it wherever you want. We always choose the default expiration of where most of the volume is traded, which is usually between 1 to 2 months out. So the monthly option that is between 1 to 2 months out here is the October option. Can we use Air Canada as an example considering the implied volatility of COVID and relaxation of travel restrictions? Sure, let's take a look at Air Canada, which I'm sure is going to be far more volatile than Bank Montreal, which is 24%. As you can see, the October expiration for Air Canada has a 60% implied volatility. So what that means is that the 1 year expected move for Air Canada is roughly $16.97, which is just shy of 17 bucks, times, let's just call it 60%. So the expected move of Air Canada over the next year is $10 higher or lower. So down to $6, roughly $7, all the way up to $27, roughly is the expected move. So if we look at the P&L simulator, and we look at a 1-year option, we don't really have a 1-year option. If we look at April here, that's the closest that we get here. But you can use this to determine the expected move. Now, again, what I just showed you is a quick and dirty formula. In reality, stocks are not equally distributed, so we don't actually expect that it'll be a $10 move to the upside versus a $10 move to the downside. We actually expect a bigger move to the downside than to the upside because stock returns are log normally distributed. As you can see, it's not a normal distribution. You have fatter tails to the upside, and because the stock cannot go below 0, that's why you have smaller tails to the downside. So it's not equally distributed, and we account for this using a binomial tree versus a Black-Scholes that does assume normal distribution. More examples of how to use the trading simulator. So again, let's say we're looking at Air Canada. Let's say we're trading the October expiration. And basically what we're saying is that if we buy, let's say, a put option here for Air Canada, a $17 put is trading at $1.62. A vertical here, we're trading the $17 put. Why did we choose to sell the $13 put against the $17 put that we purchased? It comes down to using the trading range simulator, because for the October expiration, our expected move to the downside is roughly $13. That's why we chose to sell the $13 put. That's how we're able to optimize your debit spreads to give you the highest possible probability of this lower strike price expiring out of the money while collecting the most premium possible to offset the cost of that long call. So what you're doing here is we're reducing the cost of the put option from $1.62 down to $1.25. That's almost a 20% savings, a little bit more than 20% savings on the underlying position itself. So we are optimizing your strategies using the trading range that is calculated off of the implied volatility. How can you determine whether IV is high or low? So you don't really, it's all relative, right? So 60% is high right now for AC compared to where it was 2 years ago, but it's all relative. It doesn't necessarily, there really isn't a such thing as high or low. It's just, is it higher or lower than where it was yesterday or a month ago or whatever time frame that's relevant for your trading. But arguably, there is no such thing as necessarily high or low. It's just all relative. Why doesn't the standard deviation for BMO equal 7 and -7? It is 7 and -7. That is exactly what it is, Julian. Compared to the US markets, Canadian shares are generally less expensive. How do we look at risk and return? So, Bob, I don't think it's fair for you to say that it's less expensive because, so let's look at BMO. Right, so BMO on the it should be exactly the same. So you have so you're talking about it's cheaper because the stock is at a lower level here. If we look at BMO on the US side here, give me 1 second to pull up BMO on the US side. When we look at the October 16th, as you can see, even though it's trading at $4.60, it's a lower price stock. So your implied volatility here is actually roughly the same. So when we talk about, the options here are cheaper, they're not actually cheaper. Or in this particular case, BMO is a little bit cheaper, but not by a whole lot. So you don't want to compare dollars to dollars. You always want to compare implied volatility to implied volatility. That's the only true apples to apples, because you also have to factor into exchange rate. You have to factor into other things. So if we compare BMO US versus Canadian, you can calculate the implied volatility, and they are quite similar. If we look at something like maybe Barrick's Gold, that's another one to look at. Barrick Gold trading at 46% on Canada. I forget what the symbol for Barrick Gold in the US, oh, it's gold. Trading at 43%. So as you can see, the two very similar in terms of implied volatility, which means that the options are equally expensive, even though one trades at $2 US and the other one trades at $2.83 Canadian. Once you factor into all of these, once you factor into the exchange rates, the two are almost equally expensive. So Bob, I hope that this showed you that, you know, Canadian and US markets are equally expensive once you factor into exchange rates. How long does it take after earnings for vol to decrease? It's instantaneous. So first of all, earnings happen overnight, right? So when the markets are closed. So once they reopen the next day, that volatility instantly reprices. How to calculate the value of vertical spread when you use vertical spread strategy. Sometimes your swing options trades sort of loss of value of vertical spreads moves above a certain price. So no, that really comes down to option pricing models again. So we use an estimation of the expected future volatility of the stock. We have to assume a volatility, but that's how we are calculating the expected value of an option in the future. So we're using that in our Black-Scholes and binomial tree calculations to get a sense for what is the expected P&L of a stock sometime in the future. So using that option pricing model is actually how we derive what the expected future value of a stock is prior to expiration. Is this recorded? Yes, all of our sessions are always recorded, and we send you the recording afterwards so that you can watch them at any time. What do the red and green arrows for mean? I'm not sure what you mean by the red and green arrows. If you're referring to these on the chart here, that just tells you that this was a stock that generated a buy signal on this particular day, and this is a stock that generated a sell signal today. So it's just telling you when a stock has generated buy and sell signals. So if you're talking about a different arrow, please let me know. Another question, please. My discount broker does not allow to trade multi-legs in one trade. So how can I use such option strategies? I have to put the position of each leg and then sell if option price increase or lose at expiration. So no, my suggestion to you is there are brokers in Canada that support multi-leg options. There are plenty of them. TD does, Questrade does, Interactive Brokers does. If you're trading these multi-leg options, I don't recommend that you trade at a broker firm that doesn't support it. You know, legging in and out of an option, there's a lot of execution risk there. There's, you know, I don't recommend legging in and out of a multi-leg spread. I highly recommend that you look at option brokers that support multi-leg trading. I would never, ever recommend you to leg into one of these vertical spreads leg by leg. Where can we find historical volatility data? Jeff, you know, I'll be honest, historical volatility is not something that a lot of options traders utilize. We always use implied volatility because that's really what we're looking at. Historical volatility isn't really useful in understanding you know, the expected future volatility. So that's why most platforms don't provide it, but you can calculate it yourself. There certainly are some data sources that probably provide them to you. There are certain, you know, most charting packages will calculate historical volatility because it's a simple calculation. But again, historical volatility isn't very useful in options trading. Implied volatility is much more useful, and that's why we use implied volatility for our trading. Will the Q&A be in the recording? Yes, the Q&A will be in the recording. What's the better metric to gauge the IV rank or IV percentile? Oleg, the two are identical. They're just different calculations for it. One is not better than the other. You just have to understand the nuances of each one. So if you're using IV percentile, generally speaking, under 68% is what you're above or below 68 is what you're looking for. When you're looking at IV rank, you're looking at above or below 50 is what you're looking for. It's just the way that IV is distributed that you want to account for. One is looking at it assuming it's normally distributed. The other one is assuming that's not normally distributed. So there are nuances to each one. One is not better than the other. Just understand the difference, choose one and stick to it. That's my best suggestion to you. How do you interpret the difference between implied volatility and historical? The answer is you don't really. A lot of people like to do that, but I don't think that it's very useful in determining, you know, because historical volatility has nothing to do with implied volatility. The two are completely separate. So yes, you can use historical volatility to say this is what's likely going to happen, but that's not what's going to happen. And you want to remove those two from each other. Maurice, on the trading range simulator, why is the amount below not equal to the amount above the current stock price? Because stock price returns are not equally distributed. So that's why. You know, I'm sorry, they're not normally distributed because A stock can go to infinity, but it can only go down to zero. It can't go any further to zero. So it tends to be compressed to the downside and extended to the upside. It's not normally distributed. That's why you don't have an equal amount up or down. Is there a specific time frame that you want to get out of the option? Khan, that really depends on whether we're talking about buying and selling, whether we're talking about a spread or a single option. There's a lot of factors that go into it. So it really depends on the strategy itself. If you have a specific strategy, feel free to comment and I'm happy to respond. Does IV include the time to expiry? No, IV is always annualized, so it doesn't account for any type of expiration date or anything like that. You know, obviously shorter dated options have, generally speaking, higher implied volatility. Longer dated options have lower implied volatility. Can you use it when buying weeklies? Example, 3 days before expiration. You can use it for any expiration. So like I said, you can choose any expiration date. So if you want to choose for BMO, the one that expires in 4 days, you can. I will tell you, if you look at my other webinars on selecting expiration dates and strike price, there is no good reason anyone should ever buy a 4-day option or sell a 4-day option. Generally speaking, anything under 21 days, you shouldn't be touching as a trader, because if you're buying an option, that's too short. If you're selling an option, you have too much gamma risk. There's no reason, generally speaking, from our perspective as a professional, that we generally trade anything under 21 days. I know a lot of beginners like to do it because, you know, when you're buying an option, they're really cheap. But guess what? When you're buying cheap options, you get what you pay for. And on the flip side, when you're selling options that are really cheap and you're thinking to yourself, oh, the stock only has a few days. If I sell something really far out of the money, I'll be good because there's a very high probability of success. High probability of success also has its pitfalls. Yes, you can win 9 out of 10 times, but that 10th time you lose, you're going to lose big and it's going to hurt a lot. So be very careful when you're trading these really short dated options. There's a reason that professionals never touch them. I have heard that selling a put less than 1 standard deviation would usually end the stock price 84% out of the money, or vice versa in the case of buying a put. I understand how 84% was achieved. It's exactly what I just showed you here before. You know, when you expect, so for example, if you sell something 1 standard deviation away, then 84% of the time, the stock will be above that price, because only 16% of the time, the stock will be below that strike price. So that's how those numbers are calculated. So if you sell something exactly 1 standard deviation, so in this particular case, this is a $50 stock. If you sell the $40 put, there's an 84% chance that that put will expire worthless, because there's only a 16% chance the stock will be below $40. So that's how that calculation is done. What would be a good volume or open interest to consider? Open interest and volume means very little these days, simply because there are hundreds of strike prices. So who cares what if someone happens to trade the 1 strike price that you're trading? What you want to look at is the bid-ask price, the difference between the bid and the ask price. The tighter that spread is, the more liquid something is. The wider that something is, the less liquid something that is. That's a much better indication of liquidity rather than open interest and volume. There are plenty of times that I've traded options with 0 open interest, 0 volume, and I get filled at the midpoint, because nowadays market exchanges are just listing thousands and thousands and thousands of strikes. So naturally, open interest and volume is going to be distributed across a much larger number of instruments. That's it. That's just the nature of how many instruments you list. The more instruments you list, the smaller the open interest and volume of each option is going to be. What you want to look at is the open interest and volume of the whole chain. So if you look at the whole chain and the volume of the whole chain is 10, maybe that's something you should stay away from. But if you look at the whole chain and there are thousands of contracts being traded and thousands of contracts of open interest, that's what you want to care about. The daily calc of IV, Drew Lee. I'm not sure if that's a question or a statement. Feel free to expand on that. I'm happy to answer your question. Gina is saying, how important is open interest and volume? I hope the last question I just answered helped answer that. Will we get access to the recording? Yes, these are all recorded. Unfortunately, no Canadian broker offers vertical spread strategy, the third optimized strategy, as far as I know. Are there any other solutions? That is not true, Shahin. There are plenty of brokers that offer multi-leg trading. Questrade, TD, Interactive Brokers are 3 that I can name off the top of my head. And and I can tell you, I just did a webinar with Steve Sosnick, the Chief Strategist of Interactive Brokers, last Monday. I know for a fact that they trade multi-leg options, but so does Questrade and so does TD in Canada. I would like to know if I can watch this webinar again. Yes, Boris is saying on the graph. Boris, if you don't mind clarifying. Oh, I think you mean the red and green arrows. No, I mean the red and green arrows on the bell curve. The bell curve red and green arrows. So he's asking, what do these red and green arrows on the bell curve mean? They're referring to the support and resistance lines on our chart. So we also show you, based on the expected trading range, where the next support is, where the next resistance is. Many times when investors, we can either use a standard deviation or we can use a resistance many times as our determination for selecting strike prices. So that's why we use these carrots to help you quickly determine where the next support or resistance lines are. Is the IV shown on the P&L simulator specific to the chosen option date? Yes, it is. So when you choose an options expiration date, the implied volatility is always selected for that expiration date. Why the Canadian options volume and interest is very low? I have to go to the US markets for volume for options. So, Vinay, I mean, here's the thing is that, again, Canada's a smaller market. That's why you have lower open interest. But that doesn't mean that it's less liquid. So don't confuse the two things with each other. Many people tend to confuse open interest and liquidity. The two are correlated, but they're not. It's not like high volatility, low open interest means low liquidity either. So don't just look at open interest and volume. And I've been trying to say this for years, and I'm not quite sure why the message isn't quite coming through. Open interest is not a good indicator of liquidity. The bid-ask spread is a much, much better indicator of liquidity. Anil, you're very welcome. Andrew, is there any advantage to looking at Vega and options chains rather than just IV? I don't. So Vega is telling you the sensitivity of the option to implied volatility, but far more useful is going to be the implied volatility rather than the Vega. Vega, you just want to know the relationship of Vega with in the money, at the money, and out of the money. But I don't think it's very useful to look at Vega on an option chain, to be perfectly honest. You have a preferred range for delta. Yeah, when you're selling options, you always want to sell about 25 to 10, 10 deltas. When you're buying options, you want to buy 50 to 60 deltas. So yeah, I always have a preferred trading range, but depends on the strategy. So please watch the webinars that I have on each strategy, because I do talk about what are the optimal deltas for each strategy. Do you ever use backtesting when determining the strike price? Dean, we have done thousands and thousands and thousands of backtests using decades of data to determine what are the optimal deltas. So yes, we absolutely do. I was asking about the daily calc to use when buying weeklies. You answered it. Okay, great. Is there a Greek more relevant to another? Delta is by far the most relevant Greek because that's the one that has the largest impact on the value of your call or put option. Theta is the second most important Greek because that has the second most important impact on the value of your option. And then I would argue delta, gamma, and vega are less important because at the end of the day, they generally have a smaller impact on the value of your option. And if you follow the rules that, generally speaking, professionals lay out, which is avoid trading options that are less than 3 weeks from expiration, you really don't have to worry that much about gamma and vega because those are less sensitive on longer dated options. So delta and theta, by far the most important Greeks. What percentage difference between bid and ask do you consider as a start as of uncomfortable illiquidity? I would say usually 10% between the bid and ask price is where I start to say the spreads here are a little too wide. And I would be careful in terms of entering my orders. Just as an FYI, TD allows multi-leg orders and options for US stocks. Canadian is not supported. Okay, good to know, Ralph. But I will tell you, Questrade and Interactive Brokers definitely supports multi-leg trading in Canada. Roger, you're very welcome. Kunal is saying trading range simulators assuming that stock price movements is symmetrical around the median. Is this a fair statement? No, it is not. As you can see, the expected move to the upside is not the same amount as the expected move to the downside. They're close, but they're not symmetrical. Stock returns are not symmetrical. How does bid-ask indicate liquidity? The bid-ask indicates liquidity because the more competitive quotes there are, the tighter the bid-ask quotes are. You think of the markets as one big auction. When there's lots of competitors competing for one single asset, you're going to have a lot of competitive quotes. So the bid and the offer prices are going to be very close to each other. When something's not very liquid, the bid and ask quotes are going to be much further apart. Think about trying to buy and sell an iPhone. The amount of people willing to buy and sell an iPhone are pretty large. So that's why the difference between the prices that people are willing to sell and people are willing to buy are very close to each other. Think about your house. There are far fewer people interested in buying your house or selling your house. So the difference between the bid and the offer prices are very far apart. So bid and ask offers are really just an indication of how many people are competing to buy and sell a specific asset. The more people are competing, the more liquid something is, the easier it is to get your orders filled. The less liquid something is, the less competitive the quotes are, the further apart they're going to be. Raymond, you're very welcome. Charmaine, where do you find your videos on option deltas for buying and selling calls? So you can follow us on YouTube. You can go to here, I'll send you the link here. I will send the link in the chat window. So all of our videos are available here on our OptionsPlay Canada website. I suggest that you follow us. We will send you a link after we finish here with the recording so that you can follow us here on YouTube as well. Julie, you're very welcome. Richard, thank you so much. Can you show an example of using IV with the call spread? I'm not sure what you mean by an example of using IV of a call spread. You don't use IV of the call spread. You use IV to calculate the expected trading range, and then you use the expected trading range to calculate which strikes you want to buy or sell, but you don't actually use IV directly. Can you use the daily IV to trade a contract prior to expiration, say holding the position open for 3 days? You wouldn't use the daily IV, you would use the IV of the option that you're trading. So if you're trading a 3-day option, you use the 3-day IV. But here's the thing, again, there's a reason that professionals never trade a 3-day option, because if you're buying the option, you know, the time erosion is so high, it's not worth it. If you're selling an option, your gamma risk is so high, it's not worth it. There's a reason that professionals don't touch options less than 21 days. I unfortunately see the only people trading 3-day options are retail traders, and those are the ones that generally either win small or lose big. Those are the two options that you generally have when you're trading daily, when you're trading short dated options. You know, it's kind of like, you know, there's, I don't know if anyone here plays poker, but when you get pocket aces, we always say pocket aces, you either win small or lose big. That's kind of like what trading, you know, short dated options is kind of like. Your really only choices are occasionally you win, you know, or many times you win small, and occasionally you lose big. And I don't know how else to tell investors why they should stay away from trading short dated options. I really try to explain many times why short dated options don't work out for you in the long run. I know they seem very attractive in the short run because you think you can buy something for really cheap, you know, pick up a call option for 50 cents, hope that the stock makes a really big move in a short amount of time, and you turn your 50-cent investment into a $5 investment, you have 1,000% return. But the reality is that that happens so few of the time. 90% of the time what happens is you spend the 50 cents. Yes, it's a small amount of money, but you lose 100% of it. So yes, you trade small, but you have such a high probability chance of losing it, it's not worth it. And on the flip side, if you're selling a short dated option, your gamma risk is so high, you sell something for 50 cents, there's a fair amount of chance that you lose $1 off of that, you know, and it just, you know, and once in a while, when it does, and what happens is that 9 out of 10 times you might collect 50 cents, and that one time the stock makes a big move and you lose $5 off of it, and you wiped out, you know, 10 trades along with it. It's just not it's not a strategy that works for you in the long run. So I hope that this helps, you know, educate users on the responsible use of options. I know there are many attractive uses of options, but I usually say that the attractive ones are usually the ones that cause you to lose money in the long run. So hopefully this also gives you a better understanding as to how to think about the expected move of a stock. So for example here, you know, the expected move of a stock here over the next 4 days is between 76 and 79. But you'll find that when you sell a 79 strike option, you're going to collect very little premium for it. It's just not worth it for you in the long run. That's what I have to preach. Are there promoters out there, such as on CNBC, who tout about high volume, calling it unusual activity compared to open interest? What's your thought about this? So here's the thing. The thing about high volume compared to open interest is not because that's useful. The only reason that they look at high volume compared to open interest is because that's the only way you can tell if a large trade is opening. Because if, let's say, there's high volume and high open interest, you can't tell if that's an opening or closing transaction, because closing transactions are useless from an unusual activity perspective. So, and it really has nothing to do with the fact that open interest is high or low. It just has to do with determining whether it's an opening or closing transaction. Because if you have 20,000 open interest and you see a 10,000 contract trade, you can't tell if that was to open or to close. But if you have a 10,000 contract trade and the open interest is only 300, then you know for a fact that was an open transaction. So you know someone's initiating a trade, so that's worth looking into. When you don't know if it's an opening or closing transaction, that's when you can't really get any information out of that. So that's why, you know, we look at high volume compared to open interest. So with that covers all the questions that I wanted to cover with you here today. I hope that this was helpful in helping you better understand the concept of volatility and implied volatility and how that factors into your option pricing model and how that affects all the other decisions that you make when it comes to options trading. So with that, thank you so much. I hope that you guys have a great evening. And I will send out the recording here once we finish processing this. And please, if you have any questions, feel free to email us at info@optionsplay.com. Until next time, have a great evening.